start the recording. Let's wait for a few more minutes before we start. Great. Thanks for confirming that you can see both my screen and the can hear me well. Okay, let's get started. So thanks for attending today's webinar. I want to just do a quick introduction of myself to make sure that people who attend this webinar knows who I am before we go into the multifamily quick deal analyzer that we have developed. So let me just put this aside. Okay. So I'm James Kandasamy. I'm managing member of Achieve Investment Group. I primarily focus on multifamily, buying large value add multifamily, focusing on Central Texas area. So this has a write-up of myself. I do write some blog write-ups, so if you want to look up in my website, achieveinvestmentgroup.com, you can go and do that. I'm a senior manager in a reputable semiconductor company, electrical engineer with an MBA, so that comes with a lot of analytic thinking plus the business perspective as well. Does large-scale engineering management as well that focuses on the phones, chips that goes into the smartphones. My wife Shanti is the managing member as well on the same company, and she focuses on the property management rehab of the properties. We both of us work on value add deals. We use creative methods to identify great off-market underperforming multi-family assets, and we turn around them and we make it into a nice livable rental and serve it back to the community as a good home. So a track record, let me go to the next one. We started with single-family homes, bought 6 single-family homes. Out of 11, we bought 6 with almost zero cash out of pocket. We started with single-family home and bought our 45 units in December of 2015. Quickly stabilized that. That's a value-add deal. We are paying like 12% per annum return to our investors, and that property was refinanced within 12 months. Keep in mind, refinanced within 12 months, and we returned cash to our investors, returning total of 117% to investors. So we do expect to continue delivering double-digit return to our investors after the refinance, which basically means you have a property that you don't have any money in it, and you are still getting money from it. So that's fundamentally infinite return. The IRR, which is the internal rate return, is more than 44% for 5-year investment period for Hutchins Farms. The second property that we bought is Boston Woods apartment in San Antonio area. This property we stabilized within 77%, from 77% to 93% occupancy. We are almost done with the rehab right now. We're supposed to hit our year. In fact, we already hit our year 1 pro forma target last month. And we also expect to refinance that. So our model has been buy it at a deep discount, rehab the property, refinance, and keep the property for long term. So that's the holy grail of multifamily investing. So let me quickly go to the free multifamily quick deal analyzer that all of you guys know about and joined this webinar to know about us and also how we're going to use this analyzer. So I want to just level set an expectation on the presentation and the analyzer. So there's going to be 2 phases of the presentation. One is the features of the analyzer. Second one is the I'm going to do a sample deal that we're going to analyze using the multifamily quick deal analyzer to make sure that everybody understand on how does different parameters change to underwrite a certain deal. And this analyzer, once you come to my website, you can come to home and you can go to tools. And if you already register once, it should be you don't have to do it again, because you should have all your information already here. So once you sign up here, you come to this analyzer over here. So this analyzer was developed by me to basically streamline a lot of analyzing activity that we do on a day-to-day activities. I mean, as a sponsor who's looking for deals consistently, we come across a lot of deals across our desk, and we want to make sure that we give a quick look at each numbers and quickly give a feedback to the brokers. And we work a lot on off-market properties, off-market deals that come across our table, and yeah, even off-market property, the sellers can be selling it very high, and it doesn't make sense at the end. So the calculator was made using WordPress, basically, which means that you can access it on the phone as well. And at the top of it, I did create a how-to video, so you can go and click and see, how I use this calculator. So there is a video which you can go and see. We are assuming that you have some knowledge on the terms that's being used on the multifamily, acquisition management side of it, such as pro forma, cash and cash return, debt service coverage ratio. I can go through a bit of everything, but there's a lot more details in this. NOI and what is the asset management fee, what's the replacement reserve, and all that. So at a high level, this analyzer was made to be collapsible. Each items can be collapsed so that you can analyze, like if you want to just analyze expense, you can just do that and see on top on the pro forma what is changing. And every deal sponsor or lead syndicator or lead investors, the primary goal in analyzing any deal is to look at the pro forma returns. Can I add value, or what would be the return once I buy this property, right? So it's important that you know how to analyze and underwrite any deals that come across you, just because the brokers in 99% time, they're going to throw you some ridiculous numbers because they want to make sure that they sell, right? And so you have to do your own due diligence to make sure that you know how to do your own analysis. Is there anything that that is missing from the numbers that are given to you by the brokers, right? So the features wise, as I said, you can collapse each item into a small. So I made it so that sometimes we just play around with the rent, sometimes we play around with the bank financing and can close the rent. So you can do all that, or you can just open everything up and you get to see the whole calculation here. And each of these items, you can always clear it on its own as well. Let's say you have a 2-bedroom and let's say 45 rent, you can clear it just this part itself, so everything else will stay the same. So that's another feature of the analyzer. And the analyzer also, when you scroll down, we kept the banner on top as remaining as it is, because we want to make sure, I mean, a lot of times, as I said, the bottom line is you want to see how your cash and cash return, how your DSCR changes, what's your valuation, how does it change as you analyze each different parameters here. And in Excel sheet, it's very difficult to do that because now you have to scroll up and down, because you change something on the bank financing and you have to go down and see your cash and cash return. So it's not very easy to use. So that's the reason I created this calculator. So one is you can see on the top and you can analyze it separately, and it makes usage of the processing power much more effectively, right? So yeah, if there's any questions, let me know. Then I will address it, or we can wait until the end. So I'm going to go through right now the details of each of these numbers and how do we get certain valuation done on a deal that come across you. And keep in mind that this is a very, very basic analyzing tool, um, but it gives you a first look of a deal, right? Whether it makes sense for you to dig deeper or not, right? So a lot of times you do not want to go and do very detailed analysis, especially when it doesn't make sense, right? You're going to be wasting a lot of time. So there is a lot of things that can be added to this tool, such as if you have if you're going to invest in a sponsor as a sponsor, there is you can always add a percentage of split between sponsor. If there's acquisition fee, you can add that in. You can add many fees and how the sponsor does it. How does your passive investors get money as well? So you can add a lot of features into this. But that's all going to be a much more advanced analyzer. And also you can add in, IRR, multi-year valuation. How does the projection change every year? If you increase rent by 3% or 2%, how does it change? So you can add all that features into this analyzer. But as I said, this particular analyzer is a very, very basic analyzer, but it gives you everything you need for you to decide whether you want to dig deeper into any deals or not. So let's quickly go through this. I'm going to show an example of a real property which we bought in 2015. So this is the Hutchings Palms. This is the rent roll detail of Hutchings Palms. Can everybody see this? Let me make sure that people can see this as well. Can you all see this rent roll? Okay, good. So this is a real rent roll which I got from an off-market seller. The property management company sends a huge rent roll, but you don't need to see the whole rent roll, but you can just see the summary right now, right? So if you look at it, the rent roll has a floor plan of 1 by 1, 2 by 1. There's total 45 units with 17 units 1 bedroom and 20 units 2 bedroom. There's a square footage. What is the market rent? And what is the lease amount, current lease amount, and what's the lease square footage, how many occupied, how many occupancy, and how many units available. So this is basically a summary of rent roll. And so let's start doing that. So let's say, for example, the seller or the broker is offering you, let's say, 40,000 a door. And this was a 45 units property. So you can just keep on entering this. So it comes to 1,800. Let's do a real later life. So this property was sold to us at 35.5, if I'm not mistaken. Yeah, 35.5. So rehab in loan. So let's say you go and let's say you sit 100,000 rehab, and you have like 2,000 per door kind of thing. And closing costs usually it's like around 2% to it can go up to 5%, depends whether you're using a broker that represents you. If you have a buyer side broker which you need to pay, or if you have a listing broker that you need to pay, if he's not getting the money from the seller side, then your closing cost goes up. But in general, it's like around 2% is pretty reasonable closing costs. Rehab in loan, let's say you don't have any rehab in loan, or maybe you feel like there's zero rehab in loan, and let's go down, and let's say you're doing a down payment of 25% and interest rate of, like, right now 2017, let's say interest rate of 4.5%, term in years, let's say 25 years. So you basically get some numbers here. Total out of pocket 465, but this is not done yet because the operating capital will also depends not only on the debt service. It's operating capital basically, when you take over a property, how much money do you need to service the first month? Because depending on the time you take over the property, sometimes you don't get any money coming in, right? So you need that first month to go through, which is basically the mortgage payment and any expenses. So once we enter expenses, this number will slightly change. And let's look at I think there was 1 bedroom, 1 bath, and there was 17 units there. Let me look at what is the square footage. So it's 500 square feet. Oh, sorry, that's the rent, right? So What is current rent? Current rent right now is 545. So this just shows current rent, so 545 and 500 square feet. And the next one is 2 bedroom, 1 bath, which is basically 800. What's the current rent? 666. What is the rent? 666, and what is the 800? So this basically covers the current rent, and it calculates the monthly, annual, what is the amount of money of rent you're getting per annum, and that's totals out over here. And it shows average right now is 620 rent that you're getting. And let's say on the pro forma, this is basically once you take over the property, you are going to be putting in better process, better system, and you think you can get this 545, even the market was high, 555. Let's say even you just bring it to market, 555, and the 2 bedroom right now is 666, but let's see what is the market. Market is 700, right? So let's assume we are doing a 700 right now, and you basically get current versus pro forma increase. So you're basically increasing $25 compared to what the current operation is, and the pro forma will be $25 more. Let's go to economic vacancy. Let's say the current management is doing a bad job and the economic vacancy rate is like around 20%. And you can, in general, you can get like 10% with good management style. And let's say other income, you need to look at the profit and loss statement to get the actual number here for the economic vacancy rate and the other income. But usually, the other income, can go up to like 10% or more, or it depends on what are they getting right now. So let's assume they're getting 25,000 per month. And let's say after you take over operation, let's say you just gotta do the same. You're gonna keep the parking and laundry, everything the same. That's what it means for the other income. So if you see total net income has increased from 292,000 to 338. And let's look at expenses. You can look at the profit and loss, the T12, which is a 12-month trailing numbers on the current expenses per unit. You just take the total expenses, divide that with the unit. So let's say you are getting 4,500 per unit, and pro forma, let's say you're doing 4,700, right? Keep in mind your taxes is going to increase, but sometimes it can be the same, but most of the time it's not going to be less than what they're paying right now. So you have to underwrite to much higher number because of the expectation that the property taxes is going to increase after you buy, unless you're buying below the tax rate value, which is very rare. So you see the net operating income went up from 90 to 127,000 per annum. And the other operating expense, which is considered as non-operating expense, like for example, asset management fee, and usually a sponsor would be taking asset management fee, or sometimes they don't, right? So you can basically put like 1% or 2%, or let's say 1.5%. That basically will take you up from pro forma, and the replacement reserve can be even from $200 to $500. So let's say you do $300. Usually Fannie Mae, Freddie Mac would be around 300 to 350. It can go up to 400. Depends on the condition of the property. So, but you're basically underwriting on a typical numbers right now, right? So if you see here, actual versus pro forma, currently you will be getting cash on cash return on day one at 1.15% and pro forma at 4.8%. And let's say the market in that area, properties are selling at like 7%, and that basically will give you a valuation of whatever amount after your pro forma is done. You can see the valuation over there. So as you can see on the top, there is a cash on cash return of 4.8%, which you're doing. Debt service coverage ratio of 1.34. Most banks will ask for more than 1.2. 1.25 is very typical. So we are meeting the debt service coverage ratio, but I think the cash on cash return is it's really low for a good investment in real estate, right? But once you improve, if you see the property, you're buying it at 1.59 or 1.6. you'll be improving by, almost 200,000 once you improve it, right? So I mean, for me, this is not a good deal just because the cash and cash return is really low. I would expect double digit and above in general, um, for a good value add deal. So let's look at these numbers and see what, I mean, this is just an initial glance, right? So now the market is actually, because you're putting 100 over 1,000 in rehab, 2,200 per door to fix up some of the units. Now you can bump up the rent. So let's say 555, and now let's say you're doing 600, and let's say your two-bedroom rents can go up to 800. And now you see the cash and cash return goes up, but DSCR, which is already good, and value goes up by 2.3. Um, so basically, you can play around with any numbers. Primarily, the numbers that you will be changing is rehab in loan, but all that depends on the feasibility that you're doing on the property. So rehab in loan, like 100,000. Let's say you need more than that. You need 200,000, right? So you come back here at key in and you get like 11%. So which is still a really good deal. And valuation is 2.365 million, and you're buying at 1.59, which is almost what $700,000 in increment after you increase the rent, right? So, and let's say now the bank say we can give you a better rate of return, let's say 4.2, which is happening nowadays. This is 2017 July, so I want to make sure that I time it because interest rate changes, right? So, and now you're able to go to agency loan, you're able to do a 30-year loan. So your cash and cash return goes up. So your financing, you have a lot of leverage to play here. You can decide whether what kind of financing you want to do. At the same time, you can decide on what is the rehab in loan, and you can decide on what is the rent you want to do. And let's say, for example, now you realize that now you need more money to spend per door because you found something that you didn't expect in the beginning. So let's say your pro forma rent went up 5,000 a door, so now it's 10.54 is the cash and cash return. So in general, this analyzer gives you all that flexibility for you to play around with the numbers and to analyze whether the deal makes sense or not. And as I said, this is a very, very quick deal analyzer. If the numbers, even looks like 7-8%, that is still okay because you have not gone deep into the feasibility and market survey and all that for you to decide. I think once you come to that kind of numbers in terms of cash and cash return, you should definitely go into a much more detailed analysis on whether the deal makes sense or not. I think that's all I have. Let me see what are the questions we have right now. So if there's any questions, you are welcome to ask me. Can you save the data? Right now, no, not on the basic analyzer. So I am thinking on working on a more advanced analyzer where people can log in, save the data, retrieve the data. You can change. You'll have much more charts with graphs and all that. That'll be much more advanced analyzer. But this basic one, it's very basic. It's for me to get feedback for now. So all feedbacks are welcome. How to find the cap rate for the property? So the cap rate for the property is basically current NOI. The current NOI, hold on, the current NOI. So if you look at here, the current NOI is 90,000. Divide with whatever price that the seller's offering you. So it's 90, where is that? 90,000 divided with 1.597, and you get the current cap rate. The more relevant question would be, how do you find the pro forma cap rate, right? So let me address that. The pro forma cap rate is basically a knowledge that you need to know on your market. So for example, in Central Texas, San Antonio area, the Class C cap rate right now is like around 6.5 to 5.5, whereas Class B is like around 4.5 to 5. And you have to know the data. I mean, one other way to know is you have to can call any broker and ask them, or you can always go to um, subscribe to Marcus and Millichap reports, annual report, and they can give you the cap rate for every market in the country. Let me look at other question. Explain again the replacement reserve. So replacement reserve is the requirement where the bank will ask you to reserve. So let me take that back. So it's not all bank will ask you to do that. Freddie and Fannie Mac, which is considered agency loan, will mandate that you set aside some money for replacement reserve, and this is usually by unit. On a monthly basis, they will take your some money away so that they put it aside for your replacement, which is basically replacement of ACs, replacement of flooring, replacement of appliances, and all that. They want to make sure that the owners does a good job in maintaining the property. A lot of conventional bank doesn't really require you to do that, but I think it's definitely a good practice for you to set aside replacement reserve because the property needs upkeeping and it's important that you keep it aside. Is this available for us by logging into your website only? You can go directly into this. I mean, yeah, this is only in my website right now. So you have to come to the website to do this, right? I mean, I don't have any public domain to do this. But if you want to come directly to this calculator without, signing in, I mean, signing is very quick. But if you do not want to do it, just come direct to this link, which is Achieve Investment Group / Multifamily Quick Analyzer. So you just come here and you key in here. Oh, this whole thing's going to go. So then you come to this calculator directly. You don't have to sign up. What about comparison of side-by-side two properties? So that is not in this analyzer. There's no real need to do a side-by-side between two properties in multifamily, because usually when you get a multifamily deal come across you, you only have that particular deal to analyze. So I don't think so there's a reason for you to do a comparison of two properties to see which one is better. With the market being so tight right now, the supply is so low, it's very hard to get two property which you'll be able to get under contract and able to choose. It's just not realistic. So you're going to get one by one every day and you're just going to compare, right? So but as I said, it doesn't have a save feature right now. That's more advanced feature for us to develop, so we didn't develop that. But you can definitely print this out or take a screenshot of the whole numbers and put it on paper and compare it. And but however, in the advanced analyzer, we will have the ability to retrieve and change data by logging into the advanced analyzer. What about capex? That's a good question. The capex is basically part of the replacement reserve as well. You want to put, I mean, this basically is some of the money that you're putting aside for capex. And the other thing is all this, the rehab in loan is also your capex. And sometimes we also put rehab not in loan, which is basically rehab money that is not sponsored or not financed by the bank. That would be another capex that you can put in. But to do a pro forma analysis, capex is not really a indicator that you will be part of the pro forma cash on cash return. A lot of multifamily valuation is on the NOI, the net operating expense. Let me see what other question I have. Management fee will be part of the expense ratio. The question is management fee, where will it be added? So when you do your expense management fee, which is usually 3 to 4%, is part of the expenses per unit. So when we talk about 4,500 or 4,700 per unit, that's already including the management fee. So this calculator is basically developed by myself to make sure that we can do a quick analysis. Every not sorry calculator, every analyzer has their own features. um, what it does in a very short time is basically let you know whether the investment is um, viable or not. One thing that is that to be cautioned of is this doesn't include any interest-only loan options. So right now, if you look at the way, I mean, interest-only is basically where the bank gives you, sometimes they give you first 3 years, you just pay the interest only. There's no principal. That helps the uh, the deal sponsor to turn around property, and at the same time, it helps the cash and cash goes up as well. So in this analysis, there is no, we are assuming that you are paying principal and interest only at the same time. So when we're looking at the mortgage interest, principal reduction, debt service, this is all including interest only. So, but nowadays there's a lot of loan options which give interest only. So that is not included in this analysis. That is something that we have to develop into the advanced version of it. Okay, I think that is the questions. Any other questions? If not, yeah, you can always send me questions to James at Achieve Investment Group. So that and also any feedback so that we can start to improve this, and when we have time we'll work on the advanced analyzer. But right now this is what it is, and I think it's a very streamlined analyzer, and it helps to analyze deals very quickly. If there's no other questions, I'm gonna end the presentation. Let me see. I'm gonna make sure that I covers everything. Yeah, one quick thing is on the DSCR, debt service coverage ratio. So this is basically an indicator that the bank use to see whether the NOI is able to be supported. Well, sorry, the other way around. The mortgage payment will be supported by the NOI. So basically, mortgage divided by NOI should be 1.20 and above. Sorry, the other way around. NOI divided by mortgage should be 1.20 and above. Any other questions? If not, I think that's it. Thank you very much. Send me a mail if you have any other questions or any feedback. And as I mentioned, my email address is james at Achieve Investment Group. Thank you for spending the 30 minutes of Wednesday evening with me. Thank you. Bye.